Hi everyone, welcome to another YouTube video. I would like to update you on my fund. My AMC fund shot up by close to 10% in November to end at 110. I'm up 12% over 12 months and over 19% year to date. I kept sending out emails that September and October were the best months to buy. Since the behavior of retail investor is to sell on negative news, I took the chance to pick up great companies like FICO, which is a US credit rating agencies, Market Access, which is bond trading platform, Louis Vuitton. Ladies, you know what this is for. Another service that I provide is discretionary portfolio management, or DPM, which is a bespoke service for a single account. It is up 16.4% annualized, year to date up 26%. This DPM, as I've shown on the screen, started in September 22. Year to date, I've beaten the MSCI World, which is up 14.7% versus 26% for the DPM and 18% for the Global Quality Index Fund. Now, over 12 months, the MSCI World is up 11.28 versus 18.9% for my DPM. So my DPM has beaten the MSCI World by more than 7 percentage points. Moral of the story is, if you choose the wrong fund manager, the wrong advisor, or listen to so-called experts on TV who don't have a track record, you will suffer a delayed retirement plan by a decade or more. Listening to a bank cannot protect you from losses if the bank keeps getting it wrong. I know 90% of the economists were gloomy at the start of 2023, but S&P 500 is up over 17%. And if you have a portfolio of $5 million, your opportunity cost of staying out of the market is 17%. And 17% of 5 million is 850,000. Think of what you can do with this 850,000. Put a down payment for a new house, go for a long trip. Therefore, choose wisely. This was a presentation that I made to a client on 7th of August this year. I mentioned that we have seen the lowest point for that portfolio on the 14th of November 2022. On 7th August this year, this portfolio was up $557,000. Today, it's up another $300,000 to $824,000. Why was I bullish on stocks? The US CPI came out lower than expected, although the core inflation stayed the same, but it relieved investors of the potential pressure that the Fed may hike rates at a meeting next month. This information prompted a huge rally in all types of bonds and lowered the 10-year rates significantly. After hitting a high not seen since 2007 of 5%, the 10-year Treasury bond rallied all week. Since the early November, the 10-year rate has now declined by about 50 basis points. This also caused the US dollar to sell off as money fled safe havens and found its way back into risk assets, higher yielding bonds, and equities. A weaker US dollar is good for stocks, as well as other risk assets. With bonds rallying and the stock dollar sinking, stocks gapped up from the start of the day last week, Tuesday, and put in a second best daily stock market performance since much earlier in 2023. It is estimated that $23 billion of the $6 trillion in money market funds sitting on the sidelines found its way back into the stock market. We saw significant inflows into the market in November. These were also the second best inflows of the year, matching what took place back during February's explosive stock market move higher. The positive market sentiment recently is signaling that investor bets believe the Federal Reserve is done hiking interest rates that were necessary to rein in inflation. So no more hikes for the rest of the year. This week's CPI and PPI data indicated that the price surges are beginning to ebb or come down, and the economy is slowing as the Fed intended by raising rates for the past 20 plus months. The rally in S&P 500 and Nasdaq is not just driven by the Magnificent Seven. We see Avago, Eli Lilly, AMD, Berkshire, Costco, MasterCard contributing as well. Incidentally, this is the only year that 7 or rather 25% of the S&P 500 stocks outperform the S&P. In normal times, in the past decade, on average, about 40% of the S&P 500 stocks outperform the index itself. So it is not so difficult to say, oh, if I missed the Magnificent Seven, I couldn't have outperformed the S&P. Well, that's not true. So as long as you pick good stocks and pick the top best 10% of S&P 500, you got a pretty good chance of beating the index. Can the upward bias of the stock market continue? Yes, we have pointed out in previous market outlooks, along with a wide multitude of charts and graphs to show that we are now in the best 6 months for investing, which is November this year to April 24. The seasonal upward bias is upon us. Given inflation cooling, interest rates coming down, the recent weakness of the US dollar, weakness of the price of oil, well, oil fell from $85 to $72 per barrel, and so far, geopolitical risks not spreading. We are in a more positive environment for stocks. These are all important inputs that may prompt stocks to run further. According to FactSet, earnings are great. Revenue reports have been great so far. 94% of S&P 500 companies have reported their Q3 results, with 82% beating their earnings estimates and 62% reporting revenues above their estimates. These are better than the analysts' early 2023 expectations and are certainly contributing the upward bias of good quality stocks and the major influence of the rise of the major indices. Now remember, every time it is the expectations, whether the actual results have beaten the expectations, that drives the stock market to rally. If it's in line with expectations, then the index or the stock has already reflected the correct expected earnings. Here, the red-colored line is the average S&P 500 returns since 1950 for the year before the US presidential election, which is this year. Okay, and you can see after a red-colored phase between August to October, we have now entered a yellow portion, which is the bullish phase. Let me also point out a couple of cautionary signs or risks that, things that may stop this rally. For example, geopolitical risks, spreads that you could more severe action in the Middle East, Ukraine, or even more problems, some problems within China and Taiwan. Energy prices suddenly spike, most specifically oil prices go up. This could be because of the point that I mentioned above, or perhaps OPEC nations cut back on production. This would be inflationary and stall the cooling inflation rhetoric. Inflation has a hiccup that might prompt the Fed to regain a more hawkish approach. Next is stocks are overvalued and may need a pullback if the earnings expectations for 2024 do not support this bullish thesis. In our estimation, the market currently is selling for over 20 times current earnings and probably 18.5 to 19 times if earnings were to grow by 15% this year. That is not likely to happen. So the S&P 500 at current earnings is more likely fair value at 3,800 to 4,200. But that doesn't mean that the stock market cannot go above that 4,200. Oftentimes, in fact, it shoots above the fair value and shoots under as well. Last, there are a few blaring gaps in the recent activity of the S&P 500 just popped up, and there's a gap between each candlestick. So most gaps, especially this big, gets filled back in the next 60 to 120 days. That means the index tend to cover the gap again before going up. So there will be a wave down. While nothing is guaranteed, we want you to know that these blue circles, gaps attract money on the downside. This is a slide that I presented to clients back in October 13th, 2022. It was the lowest point, and I said that back then, and I said that for the whole of 2023. I've been saying that this probably the worst is over. Here is a snapshot of my fund's top 10 holdings. They are all cash flow positive companies. They are growing and they have low debt. They are white mode companies. We have Microsoft, ASML, Apple, Fortinet. I added FICO as well. So if you wish to find out more about my services, reach out to me at hi@titaniumsynergy.com or jeffrey.ong@titaniumsynergy.com. Next, an update on UK real estate. The autumn budget was announced. So regarding home building, the Chancellor Jeremy Hunt promised to unlock new home building with £110 million over the next 2 years, unlocking 40,000 homes. He also pledged 32 million to bust the planning backlog and develop fantastic new housing quarters in Cambridge, London, and Leeds, which will lead to many thousands of additional dwellings, as well as allocating 450 million pounds to the local authority housing fund to deliver 2,400 new homes for Afghan refugees and ease homelessness pressures. The Chancellor also promised a consultation into new permitted development rights, which would allow any house to be divided into 2 flats, provided the exterior remains unaffected. This is where we get it right, as new supply will almost certainly be apartments than houses. If houses are allowed to turn into flats, think about it, the supply of new landed homes will shrink further and lead to better capital appreciation and rental growth. And our unique selling point has always been to promote and give you access to houses in the UK, which is detached, semi-detached, or terraces. The mortgage guarantee scheme, which was due to close to new accounts on December 31st this year, has been extended until the end of June 2025. This scheme encourages lenders to offer mortgages with a 95% loan-to-value ratio, and it's designed to help first-time buyers with smaller deposits. Through the initiative, it was launched during the pandemic. Buyers can put down for 5% of total value of a home worth up to £600,000 as a deposit, while the remaining 95% is covered by a mortgage. If you think that this is a terribly high 95% LTV and will cause another bubble, well, this time round, the UK government has learned there are controls. Income multiples are still restricted at 4.5 times of income. So it limits the amount that buyers can borrow, although legally you can borrow up to 95%. If you don't make enough money, you can't borrow that much. It's only 4.5 times of your income. Next up, the cap on local housing allowance will be lifted to 30th percentile of local market rents. The rise will give 1.6 million households an average of £800 of support the next year. The current London housing benefits caps are around £260 per week for a 1-bed property, £302 for 2-bed, and £354 for 3-bed. Now, unfreezing the local housing allowance rate would allow people to claim support for their current local rent prices. This is a kind of a subsidy where the government helps out to pay a part of the rent so that they can go to the private rented sector and get a home. And then part of it is paid for by the government. Now, how they peg it is interesting. The 30th percentile is calculated by taking 12 months of lettings information from the previous year, then basing the rate on what the cheapest 30 out of the 100 homes will cost to rent. So it's a lower end, lowest 30th percentile. Okay, in practice, this should make the lowest 30% of the local market available to tenants who receive local housing allowance. Okay, the government pays that person on the allowance scheme. LA share has been frozen, however. So look at the way they base it. Yeah? Since 2020, and was based on rents from a further 3 years ago, 2017. So the base, the rents, the figures that they get, the 30th percentile, is very old. It's not been revised. So imagine the rents have gone up so much since then, and people on subsidy are getting this amount of allowance. It's been frozen for so many years. The average London rents have risen 28% since 2019, adding more than £500 to the average rent bill. So on hindsight, we have been very wise. Again, our methods have stood the test of time. We have avoided renting to the lower social strata, but there's nothing against them, but we felt that the white-collar tenants are least vulnerable to recessions. And the areas where white-collar tenants like to live will be more aspirational, leading to better capital growth, because you can't afford to buy the place, so you rent it. But when you rise in the corporate world, or you get financially more secure with more savings, you want to buy a house in that area, which is a white-collar area, not in the lower tier of the social strata. The UK market remains resilient all in, although it has corrected a little bit, and that's why we kept saying that it is a great time to buy right now. Okay, but it remains resilient, and we are steadfast in our focus on growth cities, buying only large landed houses where the supply is constrained, and they can provide multiple exit strategies, such as eventually perhaps doing some extensions, even permitted development rights like splitting the flats, okay, and or selling it wholesale to another investor or homeowners in future. So if you want to find out more about service, reach out to us at hi@titaniumsynergy.com. Click on the link below, and we will see you there.